This is a Momentum Media production.
Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
And that's what we do here on Inside Commercial Property. We cover all things commercial investing. Phil Tarrant, co-host. With Scott O'Neill, founder, director, Rethink Investing, co-hosts, the brains trust, the smart bloke out of this outfit, where we get stuck into commercial investing. Lots of feedback recently, which has been good. You would have all heard last time, if you did tune in, give me some details on a new commercial purchase that I'm going through, and that's just really a bit of an opportunity to give a real warts and all example on investing in commercial property. As most of you probably know, I've sort of got quite a big residential portfolio, so picking up some commercial stuff's always been on the agenda, and the team over Rethink has sorted that out. Go and tune in. I'm not going to tell you what the purchase is and was, but if you go and listen to that, you'll hear all about it. But a lot of the feedback, Scott O'Neill, is that people like the investor stories. They want to know outside of the theory and outside of the rhetoric and outside of us going on about the economy and what it all means and what it means for commercial property. They go, that's all good, but I want to hear real stories about what's going on.
Yeah, that's right. I was shocked by the amount of messages we got from every level of investor. I've probably got somewhere around 50 in the last couple of weeks.
And emails to you going...
Just wanting to get onto the show. Yeah. Okay. So I think, there's a good lineup of people we can bring in, all different backgrounds and people very relatable. And then, we've got all sorts. So, looking forward to the next few months because I think we can chat to some more people and tell their stories because they've heard ours. And I think
everyone's heard your story. You wrote a book about it, right?
Yeah, exactly. So you can't hear that too often.
I'm already fatigued by it all, and he's always in the paper as well. When they even want some fancy commercial property guy, they put a picture of you with your shirt off.
Oh God, mate!
On the
I don't know what
Mail.
you're looking at.
But I say that in jest. But Scott's pretty well regarded these days in terms of commercial buying circles, and this podcast, Inside Commercial Property, is my opportunity, our opportunity, and Scott's opportunity to get sort of stuck into commercial property and help those people, whether they're transitioning out of resi, thinking of widening out their portfolio in different asset class. We have a lot of people tuning in that regards. We have a lot of diehard commercial investors that wouldn't even consider a residential property. They sort of screw their nose up at it. Maybe that's where we can probably start today. Scott, we're recording this after the 50 basis point increase by the Reserve Bank at the start of June. Let's cover it off before we get to our guest. Scott, what does all that mean for commercial property investors? We sort of touched on it, but mortgages are going to get more expensive.
Yeah, that's right. So there's basically an extra cost for lending right now. All commercial investors, the diligent ones at least, have predicted this for a very long time. The rates are very low. Even once the increases are hit, it's still a relatively low rate historically, and investors know that. And I'm on the coalface, so I don't get into the headlines as much as many other people. I'm just getting on with my day dealing with direct clients who are wanting to invest. And we're seeing overall slightly less investors out there. In terms of it, the dollar size, the entry-level guys are slowing up the quickest, but the higher net worth or the above mum and dad level, that's actually increased in recent times. So in terms of our total leads coming through, the number is less, but the dollar amount is higher, which I'm quite surprised by, but it's what I would be doing if I was investing. I think it's a good time to actually negotiate a good deal. It's still a seller's market by a mile, but it's better to buy right now than it was probably 2 months ago because there's just a little bit more reason for someone to sell and you could just negotiate a little bit harder. So smart investors know that. They're not holding back. We buy for the long term. There is no big fall coming for commercial unless it's a completely terrible type of asset, because the cash flow is still good and it can compound against the 8 increased rates we're seeing. And there's high CPI, so that's good for rent. So high rental increases, it's still a highly positively geared asset, so the transaction makes sense day one. Investors are still buying as normal for now.
What about resi?
Seeing it falling in the highest price markets and the highest leveraged markets. So where there's a lot of supply and reliance on first-time buyers or, guys taking a 90% lend or more, they're going to fall. We're already seeing it in Sydney. You've got to remember a lot of this is off the back of a 30% growth rate in the last 12, 18 months. So if it comes back 10%, not only is that, required, it's sensible in many areas. So I think there's going to be further falls to come, but I think there'll be a bounce back in confidence as soon as a rate rise doesn't happen. So if they go in hard right now and then they don't rise for 3 months in a row, that will indicate the bottom of this cycle, or the height of the interest rate cycle, and investors will take confidence out of that. Yeah,
I'm a lot of reading I'm seeing now, Scott. They're saying that all the inflationary pressures are starting to sort of get to its peak, right? So the justification for continued increasing of rates, who knows? But a lot of the banks are still pricing in, another good percent in there, right? So in this particular cycle, we'll watch it and give some interpretation around commercial property. But irrespective, I think the best investors, to your point, Scott, are those looking for opportunities in this market, and there will be opportunities out there, whether it's resi or commercial, but this is obviously a commercial podcast. So it's good to actually get a feel, a sort of a pulse check about how investors are feeling right now, whether or not these interest rate hikes are going to dampen your attitude towards investing in property or put the brakes on your next commercial purchase. You can get in touch with us. Scott, the best email is
info@rethinkinvesting.com.au.
Okay, and that's where you're getting all those messages to. Yeah,
exactly. Yeah. And look, keep messaging if you want to get into a future podcast. Like, we're going to keep running this for the long term, and we're going to mix it up as much as possible. But yeah, I like the idea of guests because, it's what I was interested in when we first started listening to your podcast, Bill.
Back in the day.
Back in the day. That's what got me onto it day one. So
yeah, real stories, real people. And I think what, to that point, Scott, what doing podcasts and having chatting with many property investors, people have got this idea of what property investors are and look like and feel like and sound like. And let me tell you, property investors is just any given Australian just getting on with it. I think, 1 in 8 Australians, I think, invest in property or somewhere or other, something like that by memory. So there is no typical property investor, and they're not the guys and girls driving Ferraris, getting out with no socks on and fancy loafers. It's the person next door is probably a property investor, and it's probably the person next door is investing in commercial property. You just don't know about it. So this podcast here is to try and uncover those people, those that are happy to come and have a yarn with us and share their experience. One of them is Brett Parham. He's working with Scott at the moment. We've asked him onto the show. He's just kicking off with property investing. So, just try and understand his mindset and why he's going about getting involved in commercial property. And these are the stories that everyone wants to hear. How you going, Brett? You well?
Excellent. Thank you for having me on.
Is this the first time you've ever been on a podcast?
Absolutely.
How's it going for you so far?
No, I'm not nervous at all.
No? So what do you do for a living, Brett?
So I'm an automotive spray painter.
Okay.
And predominantly working in the hail damage part of the industry.
Yeah.
So I'll float around the country following the storms around as a subcontractor. And the work certainly fluctuates most of the time. And luckily enough, I'm working in Sydney at the moment.
Okay.
That's why
so where are you from? Where's
I live in Brisbane.
You're in Brizzy. So you just move around fixing cars, depending on. So do you sit there and just pray for hail?
Absolutely.
Yeah. But is there enough hail going on to keep you gainfully employed?
Surprisingly enough. Yeah. You sort of, you tend to hear about the worst ones, but there's always little ones that happen here and there, and, keeps us guys, earning money to pay the bills. So
yeah, okay, praying for hail. So I used to be able to look at a cloud and watch. When I used to do a lot more surfing, really understanding weather patterns and stuff. You could look at things and go, okay, I know what's going on now. How do you know hail's around the corner?
Oh, the clouds look green.
Yeah.
Maybe.
Clouds. That's what I always saw. The clouds look a bit green. Means hail's on the way.
Yeah.
All right. That's normally when I go and park my car
if it's
under
hot
a shelter.
and there's a big storm coming in, your fingers are crossed.
Yeah. Okay. Yeah. And but the way they fix hail damage on cars now is very different than how it used to be, right?
Yeah, look, it's very quick.
Yeah.
It's very clean. I mean, myself being a spray painter, I only really come in when the damage is much more severe.
Yeah.
As we were talking earlier, it's done with a paintless dent removal type process. And when the damage is more severe, the panel gets replaced, and that's when I come in.
Just to spray it up. So did you do a automotive spray painting apprenticeship? Is that what you did?
Yeah, so I worked in the smash industry for 21 of my 24-year career.
Wow.
And branched into the hail damage. And look, it's FIFO work, so you get, financially compensated for being away.
So you get paid well?
I get paid well.
Yeah. Okay.
Yeah.
And then what, they put you up in a house, or they put you in a hotel? How do they, I'm just intrigued.
Yeah. A lot of people ask questions.
Yeah.
Look, being a subcontractor, I do have to pay for my own accommodation and travel expenses. I am reasonably loyal to one company, so they do look after me. But look, I mean, our sort of the skeleton staff for our company sort of floats around the 10 to 15 mark, but we'll certainly balloon out to about 300 staff if need be on a bigger site.
Wow.
Yeah.
Well, they just find like an old like factory and just fill it full of blokes fixing cars. Oh, because I took my car in once and that's what happened. Yeah.
As we speak, there's the old GM factory in Adelaide is full of hail damaged cars getting repaired at the moment, and that's about 4 acres under the roof as far as I know. So, yeah, there's a lot of work down there at the moment. And
you do all the spraying. You set up like a spray booth in there, and you do it all in there local, right? Yeah.
Yeah. The companies that have the insurance contracts normally set up all the facility, and we'll just come in and provide the labour.
What's it like being an apprentice panel beater? Is that hard going? You get all the good jobs, right?
Yeah, look, I think, 20 years ago I started in 98, so it was probably a lot more challenging back then than what it is now. But talk to an apprentice now, they wouldn't think the same. But, yeah, certainly less and less people are coming through in the trades these days. The TAFE classes were 15, 20 kids back then, but even when I was leaving in the early 2000s, that was sort of down in the single digits. Nowadays, it's difficult to even sort of put aside the time to try and train these apprentices. Yeah, few and far between trying to find good tradesmen these days, like any trade.
I know, we need to be encouraging more. But they're getting kids in university, they should just go and be doing trades. Anyway, that's it's not for this particular podcast. But just, I'm really intrigued by this. How much of panel beating is an art and being a craftsman versus process? Like, could anyone be, like, you've got to be quite creative to be
look, it is definitely process driven, like you said, but like I think anything, if you've got good commitment and good work ethic, and you're going to stick it out for the long term, you'll do well. But it isn't for everyone. It's especially the FIFO side of things, but it's definitely much more of a process than a creative thing.
Okay.
Yes.
Anyway, I'm just intrigued.
Yeah, absolutely.
It's really, really, really cool. So why commercial property? Like, what's going on? So do you own any other property? I
only have my home, which I have a mortgage on.
And that's in Brizzy?
That's in Brisbane. And we only purchased April last year. Okay. So we got in the Brisbane market on the way up, I guess, through that cycle. And we actually just relocated from Melbourne, just trying to find somewhere a bit warmer. And I did have a residential unit out in regional New South Wales for a number of years that I purchased through a residential buyer's agent a good decade ago. Zero growth over the last decade.
Where in region?
This was out in Orange.
In Orange,
Orange.
Yeah.
So purchased during the mining boom. Yeah, probably sold an off-the-shelf type of property at the time.
Was it brand new?
It was not brand new. It was in a complex and it was newly renovated.
Okay.
So I guess I probably paid a premium for them at the time, and only through COVID did I experience a little bit of growth at the end, and managed to shake that monkey off my back at the end of last year. And yeah, I didn't want to put the numbers on some paper to see how much I'd lost over the decade.
So you're paying a mortgage the whole way through. Were you paying off the loan, or was it interest only when you had it?
Initially, it was interest only.
Yeah.
The strategy was to use that property as a bit of a cash flow type of property because the rent was quite high at the time. Had some minor staff in there paying high rent, and that was going to help sort of leverage into a more of a capital growth style property. And look, the rent died pretty quickly, and so did my serviceability. And that was sort of history.
Got stuck.
Yeah, it got stuck.
Wow.
So in Brisbane now, got rid of the residential property, and just really reflecting on where I was in my life and where I'd like to be in 20 years' time. Potentially looking at paying down this, exorbitant mortgage by working for the next sort of 20, 30 years, or trying to get smart about my finances and trying to find a way that I can help pay this mortgage down sooner.
That makes sense. So you couldn't buy a principal place residence until you got rid of this residential?
No, actually, I did have this property still, this little investment. And we managed to sort of save up the 20% we needed for my home.
Okay.
Got our mortgage and got in there.
So you've got your home in Brizzy, and do you fly back every weekend, or like most weekends, some weekends?
Yeah, once every 3 weeks. Okay. Thereabouts.
You don't do the drive, do you? That's pretty hard going.
No, I drove down. Obviously, it's handy having your car with you, but every 2 weeks I'll get sort of homesick, and then by the third week I'll go back for a sort of a long weekend.
Yeah.
Yeah.
Okay. Well, anyway, so commercial property then is how you're going to pay off this exorbitant principal place of residence mortgage. That's the game plan, right? So the retirement strategy, is it?
It is, mate. Yeah. I turned 40 earlier this year, and my parents sort of transitioning into retirement, watching them and obviously myself following that traditional philosophy of buying a home and working hard and paying it off with after-tax dollars. Something just didn't add up to me, So, the commercial investment properties and the cash flow that it offered, initially I thought just kind of a little bit too good to be true. But after sort of doing a bit more research and chatting to Maroon, my buyer's agent, with the help of Scott, realised that, it's not a pipe dream. If you sort of push hard and work through the challenges that you come up against, it's real. Yeah, so looking forward to finalising this deal.
Getting something done.
Yeah, absolutely.
Yeah, and how did you find the guys over at Rethink Investing? You just sort of stumble across them somewhere? Can't remember.
Look, I love a good podcast.
Okay, you're a podcast, a big podcast.
I love a good podcast.
Yeah.
And I did come across the Rethink podcast. I think Scott might have been about 4 episodes in.
Yeah, okay.
And I thought, there's something in this. And so I've been listening and I'd bought his book and read his book and a couple other books. And so got myself feeling a little bit comfortable around this asset class. And in February, I actually reached out to Rethink and said, let's go.
Let's go.
Yeah.
So would you say you've been burned by a resi property? Like there've been argument to say, well, you've just bought the wrong residential property. You might be better off going down that resi route rather than straight in commercial. Is that sort of got merit to it, or you just went, no, you quite like commercial as an asset class because of the cash flow component of it?
I think resi's got its place, and I think I didn't buy well. So I was burnt through choices I made, a decade ago. I was given a choice back then to buy this regional resi unit, or I could have bought a smaller house in Western Sydney in 2012.
Oh, I would have bought the 2012 property.
Yeah, put my hand up and say, I messed that one up.
Yeah. So why did you choose Orange over western suburbs of Sydney?
Look, I think that the strategy I was presented, it was a case of I could only afford this one in Western Sydney, or we could buy 2 cheaper ones, one being a cash flow one, being this Orange one, and then another sort of capital growth style property. And I sort of chose that strategy per se. And look, it just didn't work out. By the way,
there's nothing wrong with that strategy. It's just that maybe you bought the wrong place. I don't know what Scott thinks about that.
Oh, look, I like the idea of buying 2 properties, but hindsight's a wonderful thing. 2012 Sydney. If we all knew that was going to happen, we'd probably load up.
I did. That's why I bought every house I could out in the western suburbs of Sydney. No, I'm not saying that. No, but I get it. But look, and experience is a good thing, right? It means it's helped to realign your decision making. Now you're looking at commercial property as a way sort of that you can embark on a wealth creation. So you're buying inside or outside of your super for this?
This is outside.
Outside of super.
Yeah.
Okay. So you caught up the guys at Rethink back in Feb and you went, hey, I'm ready to go. What do they say? Oh, there's a lot you got to do before you're ready to go.
Look, I probably got pretty motivated to get the ball rolling. So I sort of contacted Rethink and my accountant and my residential broker at the same time because I knew I needed to release a little bit of equity out of my home for the purchase. I wanted to set up this commercial purchase inside a discretionary trust structure. So that was the accountant's job. And obviously the purchasing side of things sort of handballed to Rethink. So a lot of it all kind of happened at the same time, but it all happened relatively quickly. Thankfully enough, I think Scott talks about a lot of, delay in sort of sourcing the right properties for people at the moment. That seemed to be the case sort of 3-4 months ago as well, but I was sort of lucky enough. Maroon, the buyer's agent I've been working with is just absolutely fantastic, and he presented the property to me within a week, I think. Within a week, we chatted a few times and he sort of had an understanding of where I was coming from and what I was after. And he presented this property to me and ticked a lot of boxes. And I guess what Rethink presented to me was pretty much what the agent had presented to Rethink as well. At that stage, none of the due diligence was done. And, no valuations were done or anything at this stage. It'd been a bit of minor negotiating at the start, but it was sort of presented me on face value, hey, do you like the look of this property? And look, this property was fantastic, ticked all the boxes. It was well within my price range. I'd been given the all clear by a first-tier lender to buy up to $1 million, and this had dropped in at, I can't remember exactly the numbers, 735, 725, something like that. And it was an industrial warehouse in, let's call it southeast Queensland. And it was advertised with a net lease of $43K. And that all, I've scribbled numbers down. That worked really well for me. So we signed contracts, we paid my deposit and we started rolling on the DD, started rolling on the finance. And look, it was only when they Rethink dove right into the lease, the ownership structure. It was actually owned, it was like I think Scott refers to it as like a lease back, where the tenant was actually the landlord, and he had it in not sure if it was in his super, it was definitely in a trust structure anyway. And look, alarm bells kind of was going off then, because I know that in a lease back, the lease was set up by the tenant per se. So I thought he's probably going to do that in his favour if he knows he's going to be selling this asset, And I think after going through the DD, it was unveiled that it was actually a gross lease. So the agent had actually presented this property to Rethink incorrect. It was actually a gross lease, and the landlord, potentially myself, was going to be liable for all of the outgoings. And it was more than the initial amount than it was advertised. But after doing all the research into the property, it was actually netting $5K less than what the agent had originally specified, coupled with the lease not having any built-in increases at that sort of annual birthday. Those couple of, indiscretions to the lease found out through the due diligence was when I sort of said to Maroon, this isn't for me. That 5.6 net lease was actually a 5.2 and no potential increases. They had an option to extend after their 3-year lease had expired, so for another 3 years. So I was potentially locked into this gross lease for 5 years with all these, these expenses potentially starting to go up over the next few years, as we know they are and have been. So I decided to exercise my due diligence clause and exit the deal.
Yeah. Did they come back to you saying, oh, no, let's do it cheaper or anything like that?
No. Look,
I was just going to say what happened in this case, because the agent, like major company and all that, presented the deal, and I believe, and this is sort of off, I can't prove this, but I believe the lawyer got involved in their lease and actually said, no, don't pay outgoings, don't put increases. Like, it really did favour the owner, and it basically left the agent and us no room to negotiate back, because like normally these things happen. This is what due diligence is for, especially with leasebacks. We can negotiate on the lease, but they just stonewalled us, and it crushed the deal for the owner as well. So I don't really get their commercial, the outcome they were looking for. Like, they obviously don't know commercial property that well, because no one's going to accept that. Yeah,
some lawyer trying to be clever has just scuppered them, really.
Yeah, exactly. So they've just wasted everyone's time, essentially.
Yeah, and talking about wasting time, like how much time, energy and effort did you put into it, Brett?
It was...
You already sort of thought, I've bought this place and here we go. It's all
2
good.
months.
2 months.
2 months, and obviously I had to pay for the building report.
Yeah.
Scott's team had done the DD, so, there was some solicitor costs that, was obviously... I wouldn't think it as down the drain, but it needed to be done to unveil what was potentially going to go wrong with this property. And the hardest thing for me, because I'm a newbie, was making the decision, is this normal or not? Is this right or not? And credit to Maroon as well. We had a discussion about it before I decided to pull the pin, and he sort of said to me, we've done all the research. These are the facts. You've got to make the decision. And in the hype of that emotion, because at that point of going through it, at that unconditional stage of that deal, it's quite scary. This could potentially go really bad, or could go really well if this is normal. So I really did, commend Maroon and his sort of objective way of presenting it to me, to say that these are the facts, but I'm not going to stray you either way. Whether you want to go through with it or not, it's entirely up to you. So I went home that night and I wrote down a few non-negotiables that I wanted out of this commercial buy. And one of them was it needed to be a net lease. And the other one, it needed incremental increases built into the lease.
Yeah.
And we went back to the solicitor that day, presented to say we want the lease changed to suit this, or out of the deal. And they declined, so I was out.
That sounds pretty mature for a first-time commercial investor to sort of do it that way.
Yeah, well, it's all about the numbers. We presented something. If anything, we're all pretty disappointed how it came out because of the time specifically and the money involved in getting to that point. And for someone to change the goalpost last minute, it's a kick in the guts for anyone.
Yeah.
So, it was the numbers didn't stack up. That's what due diligence is there for. That's why we never go into a deal without due diligence, because commercial's so much more difficult, and it is by the numbers. So if we're out 1% on the return, that makes a big impact on the price. And if we accepted that deal, we should have really had a pretty big price discount.
Yeah.
That was option B, but they weren't doing that either. So
is this still on the market? Do you know this same property?
It was always an off-market deal, and this is one of the problems with off-market deals.
Yeah.
They are no frills. Sometimes there's no big fancy due diligence done on the asset to bring it to market. It's just an agent on back of the envelope scribbles, and you might get a couple of iPhone photos, and it's presented to us in a raw fashion like that. So
that's good and bad, right? This is the bad bit of it, but there's a lot of good about that as well.
And look, 70% of what we do is off market. So this is what we're used to, and that's why we need due diligence. And I'm going to bring some numbers next podcast, like how many we actually crash as well, because there's a lot.
Well, it's just the wastage, right? But it's but the process.
It's the only way it can be, because you can't say no to everything.
Yeah.
Because then you'll lose, whatever the number is. It's a high proportion of them settle and go really well, but the due diligence uncovers the mess, and there's always a little bit, and normally it's a negotiation on price that gets you back down to where you need to be. But in this case, they just totally changed the dynamics of the lease, which there's no coming back from that.
Yeah, it's fair enough. So that's quite disheartening, but it didn't stop you, did it?
Absolutely not.
So where you're at now, you got anything on the bubble? Yeah,
we've got something on the go. So look, not long after we sort of crashed that deal, I was presented another one, and it was a little bit more expensive. It was $925K. So
the bank would allow you to buy up to $1 million. So sorry, just on that, so a 70% lend or?
This was actually an 80% lend with ANZ.
Okay.
And there's another story to this too, if we've got time. But look, it was dealing with business bankers initially, we've got perhaps what we would almost call a verbal approval from the ANZ business maker saying, look, your numbers check out. We'll let you purchase up to a price of $1 million with an 80% LVR. And, based on that, then we can sort of go in and, shuffle through whatever sort of properties I've got available. So this one sort of falled within my budget too. And this one was over in WA.
Okay.
And disclaimer too, this original property that I first went for, I actually lived 5 minutes from that place. Okay. So it was much more in my comfort zone.
Yeah.
This one was presented to me. It's in WA. And it was actually two industrial units in the purchase, single tenant. And we started the ball rolling on that one, and it was actually presented to me with a net lease of 7.12, which is obviously a lot higher than the original one in Queensland. So that's actually, I think this one was on market too.
Yeah, so it's been a pretty clean one, but there was a fair bit of action on it. I believe there was probably about 5 other buyers put offers that day. So we had a relationship with the agent, so that allowed us to, I guess, out of good faith, get priority over the deal. So, we've been able to negotiate the normal terms, like 21 days due diligence, just under a month for finance approval. And it's all, we're in that process right now.
So what is it you like about this particular asset? Is it anything make you nervous, or it's just, you said the last time around you went and sort of said what were the non-negotiables? You haven't negotiated, you haven't compromised any of those? You're happy with how the deal stacks up?
Well, initially this sort of my non-negotiables were covered already in this one. I mean, obviously, they're going through the due diligence process was going to unveil whether that was true or not, but we've completed the DD now and it is a net lease. The tenant is responsible for all of the outgoings. There is incremental increases built into the lease. You know, the tenant that's in there has been a well-established tenant that's been trading for decades. So that kind of all checked out. So look, the property itself just ticks all the boxes. There's, I think the only hurdle that we've had to come up against with the property itself is there's a small like mezzanine office in the corner which doesn't have a council permit. Okay. So yeah, look, I think they're advertising and we're purchasing the property without that sort of square meterage taken into account of the price of the lease. So Marone and I are actually looking at it as a potential, value add.
So you can go and actually get it certified by council.
Yeah, and we've got some sort of free square meterage there, which is great. The hurdle now with this one previously, which we've managed to sort of overcome, was because I had the ball rolling with my residential refinance to release this equity and originally to go towards the deposit for this commercial property. It was all happening at the same time. And ANZ actually looked at my financials, not taking into account the new investment loan, which was sort of pulled down off the equity of my home. Once we'd signed contracts on this new deal, ANZ, they'd looked at my finances. My original home loan was with ANZ and I'd pulled it out from them and went to another lender, and they'd sort of noticed, what's going on there? And they actually pulled back my lending LVR to 70%. They could only help with me with this property at 70%, taking into account the new loan. And there was a bit of I didn't actually get the apology, but it sounded like it was a bit of a mistake on their behalf. I'm like, thanks very much. This has costed me a fortune. I've signed contracts. Now, potentially asking me for another $90,000 to chip in. I don't have $90,000, So we had to go back. And we're within our finance clause already, we had to go back to my broker and say, let's look for some other lenders because this isn't going to work with ANZ. Two other lenders had sort of put their hand up and provide some offers to me, one at 80%, which is a second tier lender, and one at 75%. And so our strategy now is to actually go through the second tier lender at 80% because that's all the funds I have at the moment. I'm just shy of 75%. So in a few months, they've sort of put their hand up, say, look, we can potentially refinance this loan for you at 75%, much lower rate. Yep. And, the property then will, the cash flow will be looking a much healthier.
What sort of rates are they giving you? Do you remember?
Look, the second tier lender's not fantastic. I think the last I heard was about 5.6.
Okay.
So look, that's obviously an 80% LVR with the purchase and being a 7.12% net return.
Enough fat there to cover it.
There's enough. Even with these, recent increases and potential increases in the next few months, I'm still covered. But the lender at 75% sort of offered a 3.44, which is much healthier.
3.44. It's pretty good. Yeah. It's a second tier lender.
That's Adelaide Bank.
Adelaide Bank.
Yeah.
Okay.
Yeah.
Can't complain.
Yeah. So, look, if we can manage to pull this off, my fingers are crossed, my toes are crossed. Yeah, we're going to be sitting pretty in a few months.
Yeah, that's cool. Oh, interesting story. Is Brett's story pretty typical, Scott?
Pretty typical. Look, I wanted to bring him in because of the crash sale. I think it's good for people to hear what can go wrong with deals. You never assume any of the information's correct, ever, because 9 times out of 10, there's always a variance. Very rarely do you get a perfectly clean deal that matches to the decimal point. So this is the repercussion of that. It's normally just time. You don't get disheartened by it. Like I've personally spent, I reckon, over $100,000 on deals I haven't proceeded with over the years. It's a cost of doing business in commercial, but you more than make up for it with the ones you go through. And yeah, look, I think he's ended up with a very good property. Like even with that 5.7% rate, that $925,000 purchase would clear about $23,000 at an 80% mortgage. So for people worried about increased rates, like, you're clearing $23,000 on a sub-mil positive, it's a good result. And if he's getting a more standard rate, the cash flow is going to be around $45,000 clear.
Yeah.
If you're around that sort of 3.5 type. So
the thing, one of the measurements some investors might want to do is that how far can rates go up before you're into a negative equity position, right?
Yeah.
And with this deal, they're probably about 9%, right?
Exactly.
So thereabouts.
Hence why people are still buying commercial property in droves. at the moment.
So if you're paying 9% on your mortgage, you could still hold the property essentially.
Yeah.
You might be getting capital growth if it's that
And imagine if it went to 9%, like Australia would implode. There would be an economic disaster. It just simply won't get to that point. There's no greater benefit for the RBA to do that.
No, so I'm only reading today the new federal government under Albanese reinforcing this scheme to pony up between 30 and 40% of the equity to help the Aussies get in the property. Like they're not going to want property values to go back. They're going to be the biggest property investor in Australia. Really? What's it up to? 10,000 properties a year or something or other?
Yeah, exactly.
That's a big bananas.
Australia relies on property for a big part of its economy. It's as mining is. There's certain things that will keep us afloat, and I'm of the opinion there's going to be a bounce back pretty soon. Once we're looking at the stock market getting to new lows, there's a lot of equity yet to go back into that. So we'll see. I'll probably eat my words, but I've read a few articles this morning. They're predicting things to go a little bit further south before a bit of a ramp up. But good thing with commercial property is we don't need any of that. It is stable. It's relatively low debt, and the debts we're talking today are the highest we see. Like most of the property market out there is less than 50% debt with commercial. I know most properties we purchase from individuals have almost no debt on it, like, $5 million purchases, no debt. It's because there's some, I'm stereotyping here, some old bloke bought a property 20 years ago, sat on it, and now he's of age and he's selling up. Yeah. And he's got no debt on it, but he's got a large amount to equity to sell off and pay capital gains tax on.
Is that you, Brett? Is that going to be you, mate? You going to be a property bazillionaire at some point?
Oh, one step at a time, mate.
No. But what's the game plan? Just set yourself up with income producing assets. So when you choose to stop working, you sort of can.
Absolutely. Yeah. I think first box to tick is to have my mortgage covered. Once we've finished our finance strategy with this property, it's covered. Look, if I can replicate this, a couple of times over the next 10 years, I'm doing a lot better than most, But no one wants to work forever and everyone wants their time back. Yeah. So, that's the plan.
Sounds pretty good. And I guess sort of, you start a lot younger, but 40 is a good age to get going, right? It's never too late.
Yeah, well, I know one of the things I've learnt is most people that get into commercial are much older than residential. It's sort of like an end of game strategy. Like once you've got your resi portfolio or you've got some good successful business and you've just got boatloads of cash, like that's the space commercial investor historically has drawn people from. But nowadays, because of the price of residential and how low yields are, there's more sense for younger people to get into this space and start younger. And that's the reason I got into it, because I just couldn't stack things up properly with resi. I had a number of residential properties, and if I bought more, I probably would have just got into a pickle, just more debt, less cash flow. And
there's nothing nice about owning a lot of residential property.
No. And I was thinking,
it sounds bad, but it's an absolute headache.
Yeah, I was thinking because I always think worst case scenario with everything. What if the GFC hit and it was really bad on property this time, and I've got 20 resi properties? I just think, what would the banks be looking at? What would they call loans in? Like, what if prices drop 20%? Like, if you've got that type of portfolio, you are at risk of that worst case scenario. Now, if it hit, I'm fine. I'll sit through it. Got the cash flow. Even if the rent's, halved, it's still more than covering everything because I've de-risked the residential side of things due to the, improving cash flow, essentially.
That's good. Cash flow is king. It's good, Brett. Well, so when's the big day? When do you get the keys?
We're looking at settlement in about 3 weeks, I think.
Okay, cool.
Yeah.
How are you going to celebrate the settlement?
Bottle of Moët and, probably look at the Brisbane skyline, something like that. I think,
Go, what next?
Yeah, exactly. Yeah, I think next? These moments in life, you probably just need to stop and smell the roses and celebrate them, because it's been a bumpy road, but it's definitely going to be worth it in the end.
It sounds like you got the right philosophy, and, going into these things knowing that things aren't perfect is often the best way, because then you really can't get too disappointed. How long are you going to have to wait in the wings until you're ready to go again, do you reckon?
We do plan on actually moving closer to the city and get some tenants for our home and go out on the sort of the rent game again.
Okay.
So, yeah, look, there's a bit of equity left in the home. You know, we'll have a look and see when the dust settles on this property. You know, maybe within the next year, hopefully we can pull the trigger on something else.
All right. Well, let us know when you do that. So, thanks for coming and having you on to us today.
It's been a privilege. Thank you.
It's been really good. And there's stories we like, aren't they, Scott? You know, real world stories of, you know, just average Australian, you know. I'm an average Australian.
Standard Aussie bloke.
I don't know how average Scott is, but us average Australians, Brett, just trying to get by, dabbling in real estate. Brett Parham is a client of the team over at Rethink Investing. Scott, it's good. Let's get some more guests in, mate. That's your homework.
I like it.
Track them down. Maybe we can get someone in, maybe at the other end of the you normally find that the commercial investors at the other end of the cycle don't really like to say too much. But
they're quite secretive.
Yeah.
Their friends don't know what they own. There's a bit of a lot of that.
Yeah, keep it on it. You can come in and give us a fake name. There we go.
Yeah.
We can even put a little fancy voice distorter on there so people
I've got someone in mind that is pretty open to talk. So
all right.
Yeah, we'll make it happen.
All right. And people want any questions, anything, ideas, any comments for us, info at Rethink Investing is where it's at. Is that the best way to get in touch with you and your team as well?
Yep. And keep them coming. Like I said, there's been a lot in the last month and we really benefit from it. Like we want to keep growing this podcast and being a community tool for this investment class, because I don't think there really is any other out there that has the volume of listeners. So if we're going down a track that you'd rather go a different direction,
tell us.
All ears.
Yeah, we like constructive criticism. That's what makes this thing get better. Do that. Info at rethinkinvesting.com.au. Thanks for joining us, everyone. Phil Tarrant, and I'm executive editor of real estate here at Momentum Media. Scott O'Neill, director, founder of Rethink Investing. We'll see you again next time. Until then, bye-bye.